the ongoing new issuance of debt, the refunding of existing debt that you got to find buyers for. So I think we're all being told what's coming. The dots are there to be connected, and it creates an extraordinarily bullish picture for the precious metals. If I'm right about that, we're going to go to 4,400 faster than 5 years. And I can say that without having to come up with outrageous predictions about this or that. We don't even have to talk about the London float. We don't have to talk about silver and leverage, and it's just going to happen. And silver will go through 50, and then it'll probably be like gold.
Gold doesn't change. Neither does silver. What changes is how many dollars it takes to buy them. That's Craig Hemke's starting point, and it frames his outlook for the precious metals market. Since 2000, he notes, there have only been 3 years when gold posted gains of around 25%, last year being one of them. Expecting back-to-back years of that magnitude is unlikely. But even a 10% gain following such a run would still count as impressive by historical standards. Why the rally? Hemke points to a combination of factors, including a weaker dollar early in the year, heavy demand from central banks, and a tightening of physical supply in specific markets. If the dollar steadies, metals might stall out, but sideways movement after a surge would still be historically strong. Looking ahead, Hemke argues that policy is the key driver. With the Treasury and Federal Reserve effectively locked into low rates across the yield curve, he believes gold could reach $4,400 much faster than most forecasts suggest, possibly in less than 5 years. Silver, in his view, would mirror gold's path, surging past $50, pulling back, then climbing again, just as gold did after breaking prior heights. Bull markets in precious metals often unfold in 3 stages. First, small, gradual gains, then medium moves, and finally, an explosive finale where fortunes are made. That final crescendo, he says, hasn't happened yet in the 2020 cycle. For Hemke, the bottom line is that gold keeps grinding higher because Washington can't stop running trillion-dollar deficits. Balanced budgets are promised but never delivered. 2 years of substantial gains inside the current paper pricing system, he warns, signal something more profound. The financial structure itself may be edging toward a breaking point. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Again, till something completely breaks, we get into a different pricing scheme. I mean, this one's held now for 50 years. How about that? Then we have to deal with the system that we have. And under this kind of, we'll call it a fractional reserve, digital derivative pricing scheme, 25% annual gains in gold are pretty rare. And you just go back to the year 2000. I think there's been 3. One of them was last year. And so it'd be really unusual to have another 25% year on top of that. Even if you go back to 2011, right? Or 2020 was one. Just even tagging on a 10% gain after a 25 would be remarkable. And so that when I wrote I write that forecast every January, that's kind of what I was thinking. I thought, okay, we'll probably pop up to 3,000, maybe 3,100, because that would be a great year. Now we've been to 34. That's a hard thing to temper your enthusiasm after we came out of the gate so strong. But yeah, if we were just to go sideways the rest of the year, for any historical measure, that would be a fantastic year. So then you got to ask yourself, okay, so why are we up? Why is silver up so much this year? And I think a lot of that is just, we have this tremendous decline in the dollar index for the first 3 or 4 months of the year. Mm-hmm. Metals kind of took off. The dollar index, starts to go sideways as it has, or starts to recover, then we may continue to go sideways a little while longer. But in the grand scheme of things, Chris, I always like to point out to people, it's not the gold that's changing. It's not the silver that's changing. Those metals are just the same as they've always been. It's the fact that it took 1,100 Federal Reserve notes to buy an ounce 10 years ago. And it took 2,200 Federal Reserve notes to buy an ounce 5 years ago. And it takes 3,300 Federal Reserve notes to buy an ounce now. You can safely assume it's probably going to take 4,400 Federal Reserve notes couple more years from now. So I try to keep keep an eye on the big picture, not get too caught up in the, day trading, up and down stuff. So what's coming? Look, I think it's great that we've had this great year, and it's telling us, between the central bank demand, relative scarcity, I guess, in a sense of physical metal in certain areas, and all the tariff stuff and all the other stuff that's happened so far this year. Now, this great year so far in gold, great year in silver. We could go sideways the rest of the year. When I wrote the thing first week of January into December, I said, well, maybe we'll get to 3,100 in gold, pull back a little bit, figure, finish we up 10, 12%. Silver might blast. I thought it would get to 41 or 2 and then pull back and finish the year around 37. That might end up 37 might be where we end up. But it's next year that has me most intrigued. It took about $14,000 when Nixon closed the gold window 54 years ago. It took $14,000 to buy one.
He suspended it temporarily. Let's get our language correct here.
All right. I misspeak. He gets a bad rap. It was only temporary. They didn't have any choice, actually. I mean, U.S. has allegedly 8,133 metric tons only because he closed it. I mean, if he'd kept going, we'd have zero. But anyway, that's a whole other story. Anyway, it took $14,000 to buy one of these. 25 years later, it took up about $120,000 to buy one of these. It now takes about $1.2 million to buy one of these, which again is not unlike what I said 10 years ago, 2015, this time of the year, it was $1,100. 5 years ago, 2020, this time of the year, it was $2,200. Now it's $3,300 to buy one. Now, the gold doesn't change. Gold stays the same. So if I'm right about where I think this macro stuff is headed, this melding of Treasury and Fed and into one policy of 1.5% of the short end and 3% of the long end, and that's what the yield curve is going to be. And under those circumstances, we're going to grow ourselves out of it and everything else. If I'm right about that, we're going to go to 4,400 faster than 5 years. And I can say that without having to come up with outrageous predictions about this or that. We don't even have to talk about the London float. We don't have to talk about silver and leverage, and it's just going to happen. And silver will go through 50, and then it'll probably be like gold. Gold broke out through new all-time highs, at the end of 2023? It then went sideways for about 3.5 months, and then it went from 2,000 to 3,500. Silver will go to 50 again, probably next year. I wouldn't say it's going to happen this year. Craig Hemke says silver's going to $50 in 2026. Anyway, it'll go up there again. It'll go up there again, and then it'll fall back. And then you'll get the people that say it was a triple top. And there are no triple tops. There are double tops. There are double bottoms. Once you top 3 times in anything, 4 times, it's a trading range. So anyway, then you'll get the triple top people and all this kind of stuff because it'll go up there and it'll fall back. And then it'll go through and it'll be 50 something and everybody get all excited and it'll go to 55 because usually things, once they break to a new all-time high, go up about 10% on the hype. And then it'll fall back and 50 will become support. I mean, this is all exactly what gold did 2 years ago. Silver will do this in 2026. And then you're just in this uncharted territory, beyond which be dragons. If I've gotten anything right this year, I mean, I thought gold would go higher. I didn't think it'd go this high so far this year. But coming out of the election, there is all this exuberance and this narrative that was being put forth. And the dollar was rallying. What did the dollar index get to? 110 or something like that back in January. Because Trump was going to balance the budget. And Elon was going to cut all this waste and spending. It was $2 trillion of wasteful spending, and all this stuff. I was like, this is the biggest pile of crap I've ever heard because I've heard it before and it never happens. And it's impossible to happen. And I don't mean like it's not important, the things they did do, but the notion somehow that they were going to balance the budget, by eliminating wasteful spending. Shit, I was hearing that 30 friggin' years ago, right? And now we're 37 trillion in debt. Even the most recent, the Department of the Treasury puts out a statement.
You were in your 20s when they started saying that.
I remember it all. I mean, I was listening to Rush Limbaugh back in 1992, hearing about this stuff, right? And Newt Gingrich, and then they did try to run what appeared to be a balanced budget for a few years back in the late 90s, and there's just no stopping the train. I mean, it's just math. It's not complicated, but they try to talk certain narratives into existence. And that coming out of last year, that this year was going to be about fiscal austerity, and the deficit was going to get trimmed and all that. The U.S. Treasury, maybe people don't know this. The Treasury Department puts out what they call their monthly Treasury statement. That's creative. Every month. It's like the 8th business day of the month or something. It comes out. We're now 2 months away from the end of the fiscal year for the U.S. government. It ends September 30th. The new one begins October 1st. So we only got 2 months left. We've got all the reports through July. Even July, okay, we ran a $291 billion deficit in July. And you think, well, okay, that we probably did 350 billion. No, we did 240 billion last July. So this notion that somehow, they're really slowing things down, it's just crap. We're going to do a $2 trillion total deficit this year. When the fiscal year is over, it's going to be 2 trillion or so by the time it's all said and done, ahead of last year's pace. There's no stopping it. And Chris, this is all allegedly during a time of robust economic growth. What happens when that's
grow our way out of it, Craig?
Yeah, we're going to grow our way out of it. Hell, Bessent was out even again today saying we're going to tariff things so much that we're going to pay down the debt. And I'm like, who believes this crap? Maybe the algos. All the machines that scan the headlines and then, trade things. So anyway, if you understand that math, and I don't mean to be like this pessimistic, grumpy old man, but it just is what it is. That's why I kept buying gold and silver all through 14 and 15 and 16 and 17, right? You did too. I mean, the math is the math. And so back to my original answer about being up 2 years in a row, even within this pricing system. That's telling you something's, what's what. Maybe we're getting a little close to kind of this terminal phase of everything. And that may set us up for even more interesting months ahead.
Since the start of the year, the conversation around gold has been noisy. Tariffs, speculation, and sensational claims about metal flowing out of London into U.S. vaults have dominated headlines. However, Craig Hemke argues that beneath the chatter, a much larger story is unfolding. In February, Treasury officials quietly floated the idea of monetizing assets. Realistically, Hemke says, the only asset that fits that description is gold. Around the same time, Congress began circulating bills that would create a Bitcoin reserve and revalue U.S. gold holdings. Here's the catch. U.S. gold is still officially valued at $42 per ounce, several frozen decades ago. If revalued at today's price, that would free up approximately $800 billion on paper, considered deficit neutral. The proposal, according to Hemke, is to use that windfall to buy roughly 200,000 Bitcoin a year for 5 years, while also holding on to any confiscated coins. Slowly but deliberately, this would create a strategic government reserve of both gold and Bitcoin. Hemke believes this context explains why so much physical gold has been flowing back into U.S. vaults. What appears to be routine inventory movement, Hemke argues, may be groundwork for a seismic monetary reset. Gold isn't just a relic, it could be the lever Washington pulls to unlock hundreds of billions, while Bitcoin quietly enters the mix as a strategic hedge for the digital era. Let's get back to the interview.
I've been writing about this topic since January, February. We were told, it's all about tariff concerns and all this stuff, and all this metal. Remember StoneX, the big commodity firm, said it was 2,000 metric tons? Remember that dude? I know you don't have that clip queued up. I'm not trying to put you on the spot, but it was some dude from StoneX that said it wasn't 700 or 800 metric tons. It was 2,000 metric tons plus that had left London and come back to the U.S. There's great distortion between spot and futures, all that kind of stuff. This is another thing where I think they're telling you what's coming. Okay, Bessent on Sunday, February the 3rd, was standing to Trump's right in the Oval Office as Trump was signing an executive order.
Thinking about that because he said in the next 12 months. We're about halfway through that, by the way.
Yep. He said. Trump signs the executive order, and he says, and somebody says something about where you're going to get the money. He says, well, Scott's got some ideas on that. And Scott's standing there like, oh, shit. I wasn't expecting to talk today. And he mumbles his way through about a 2-minute answer where he talks about the asset, monetizing the asset side of the balance sheet. And that kind of gets there. So like 2 weeks later, somebody asked him about it on CNBC or Bloomberg. He said, no, I said, I mobilize the asset side. No. Again, this is where the blob sitting there interviewing him could have said, no, here's the clip. You said monetize. And I remember I wrote a thing for Sprott saying, what are they going to monetize? The only assets they have to monetize is the gold. What are they going to do? Parkland? The tanks? Some office buildings? Also in this is Trump's idea of creating a Bitcoin reserve. There are bills in front of the U.S. House and the U.S. Senate authorizing them to do this. Besson came out last week and he said, no, we're not going to buy existing Bitcoin. We're just going to, all the ones we've confiscated and stolen, from other criminals, we're going to keep those. And they asked him about revaluing gold, which is in these bills. And where he had flat out, a couple months ago, said, we won't be doing this. He said, the Treasury is looking at revaluing something like that. He said, I doubt we'll do it. Okay? Again, these subtle language differences. Okay? Not monetize, mobilize, okay, whatever. In those bills, anybody, please don't take my word for it. Google Bitcoin Reserve Act or whatever, and you'll see the House version and the Senate version. And in the U.S., the House has a version, the Senate has a version. It goes through committee, that gets voted on, and then it goes and gets reconciled into one bill because they're going to be different. And then it goes back to the House and back to the Senate. And if those both get voted on, then the president signs it. And the president said he wants to do it. And in the bill, the funding, as Besson said, would have to be deficit neutral. The deficit neutral funding of this is an accounting gimmick where the U.S., which currently by federal statute values their gold at $42.02, 42.222222222. That's in the federal U.S. code. Written in these bills is the process to amend that code. Demand that the Secretary of the Treasury, melding of the Fed and the Treasury, demand back from all the Federal Reserve banks all of their gold certificates. And then the Secretary of the Treasury shall reissue within 180 days new certificates for the Fed to hold based at the current market price. It's in the bill. It says that this is what they're going to do. Revalue the gold at the current market price. Now, again, I don't know what that means for the gold price, other than gold is a store of value, which is what Besson said last week. It's not an antique. It's not something that, as the Ben Bernanke said, we just hold out of tradition. No, Besson said it's a store of value. So we're now going to mark it back up to what it actually is. But the gimmick, the accounting gimmick is, if you change that mark, just to today's price, it's about $800 billion that the Fed suddenly has, that then they could just hand to the Treasury on a deficit neutral basis. It's $800 billion that just comes out of nowhere.
At least that won't be inflationary, right?
Well, they take that $800 billion and they buy whatever that is, 200,000 Bitcoins a year for 5 years. That's how they're going to do it. I'm not making this shit up. They're telling you where this is going to come from. So anyway, putting it back together with your initial question, 15 minutes ago, it seems like, why is the U.S. repatriating all this gold? Remember the talk about we're going to audit Fort Knox? Remember that back in February? And then that just poof. Well, if you're going to there might be some value to actually, if you're going to do these certificates, rather than just outright fraudulently say that we're revaluing something we don't have. Well, okay, we're repatriating our own gold from wherever ahead of everybody else, before everybody else gets whiff of this and starts a bank run. So anyway, that's how I think all this stuff connects, Chris. And again, I don't mean to be Russell Crowe and John Nash in his garage with, all these Post-it notes and strings. But I do think that if you connect the dots, you can see what's coming next year. And it's really not a whole lot different from me continuing to buy silver when it was $14 and $16 10 years ago, because I could connect the dots and I saw what the math was going to be. This is just the same kind of exercise, only in a much shorter term. And I think they're telling you that 2026 is going to be a doozy. Powell makes it all the way to May, when the end of his term. Trump will nominate somebody, probably, or tell who he's going to nominate by the end of the year, and people will start connecting the dots. Which is kind of what happened in February with the gold price anyway. People started figuring this stuff out, which is why we had, with the dollar going down, such a big rally to start the year. So anyway, moral of the story is I wouldn't get discouraged right now. I don't know what the price will do in the short term. Who does? They've also told us, the Secretary of the Treasury has told us that we need to totally reimagine the relationship between the Fed and the Treasury.
What's that?
That we need kind of a different, more hand in glove approach if we're going to manage all this debt, right? They've told us that that's coming. So I would imagine, I mentioned yield curve control earlier. If you're going to cut the Fed funds rate to 2%, and you remember the last time when the Fed cut 50 basis points last September, remember the bond market sold off? You get kind of a buyer's strike. And the federal government can't, we're going to be $1.1 trillion in net interest expense by the time we reach the end of this fiscal year. $1.1 trillion. That's going up, even if you hold interest rates the same, just the amount of, debt that you're charging that 3% on is going higher. So if that goes to 6, now what are we, $2.2 trillion? The line item just gets out of control, right? It becomes greater than even Social Security, just simply servicing the debt. So if you're going to amalgamate, meld together Treasury and Fed, they're telling you yield curve control is coming. And people could say, well, that didn't work in Japan. Well, it worked for a while. And what do I mean by that? The Fed will say, in this new Fed Treasury model, where the Treasury has to do all the actual issuance and refunding and all that stuff, the Fed will say, come to me. We are buyers of everything above 3%, 3.5%, 4%. I don't know. It ain't going to be 6. We are buyers of all long-term debt above 3%. And you want to talk about but this is the way it has to go. In my experience, me reading the tea leaves, they're telling you this is coming if you're willing to connect. And then be patient. That's why I get so frustrated with this, these forecasts that are like outrageous for where silver is going to be by Halloween or something. Because all that's going to do is piss people off. And when it's not whatever dollar amount by whatever date later this year, people are going to throw up their hands and, this is bullshit.
Central governments have drawn on revaluation proceeds to retire existing debts, often in exceptional fiscal circumstances. While reducing the debt stock using revaluation proceeds improves the budgetary situation marginally, drawing on revaluation proceeds may not address larger structural challenges. For example, Lebanon's debt-to-GDP ratio continued to increase even after revaluation proceeds were used to retire some existing debts. Whether this ends up being a quiet shift or a full-scale reordering of reserves, the signals suggest policymakers are at least preparing the groundwork. Do you think pairing gold revaluation with a gradual Bitcoin buildup could stabilize U.S. finances, or would it introduce more uncertainty into an already fragile system? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.